Discover practical steps to identify REITs that can provide steady dividends and long-term financial growth, even if you're new to investing. If you want your money to work for you, especially through passive income, real estate investment trusts, or REITs, can be a powerful tool. But with so many options, how do you pick the reliable ones? The REITs that not only pay consistent dividends, but also have the potential for real growth over time. In this video, I'll break down what you need to look for when evaluating REITs for dividend income. We'll keep things simple, practical, and actionable, so you can feel confident in your investment decisions. Before we start, remember, this is not financial advice. Always do your own research or talk to a professional before making investment decisions. Let's begin by understanding why REITs matter for dividend investors. REITs are companies that own, operate, or finance income-producing real estate. Think of everything from apartment buildings and shopping malls to warehouses and hospitals. By law, most REITs must pay out at least 90% of their taxable income as dividends to shareholders. That's why they're popular with people seeking steady income. But not all REITs are equal. Some focus on growth, others on income, and some are riskier than they appear. So, how do you spot the reliable ones? Let's walk through the key steps together. First, look at dividend yield. But don't stop there. Dividend yield is simply the annual dividend divided by the share price. For example, if a REIT pays $2 per year and the share price is $40, the yield is 5%. Yield gives you a quick sense of how much income you'll receive for each dollar invested. But there's a catch. A very high yield can be a red flag. Sometimes, a high yield means the market expects the dividend to be cut, or that the company is struggling. Instead, look for REITs with yields that are in line with their peers, typically between 3 and 6% for established REITs. Let's use Realty Income as an example. Realty Income, ticker symbol O, is known as the monthly dividend company. As of early 2024, its yield is around 5%. That's not the highest, but it's been consistent for decades. That's a sign of reliability. Next, check the payout ratio. The payout ratio tells you how much of the REIT's earnings are paid out as dividends. For most companies, payout ratio is calculated using net income. But for REITs, it's better to use funds from operations, or FFO. FFO adjusts for things like property depreciation, giving a more accurate picture of the cash available for dividends. A sustainable payout ratio for REITs is often between 70 and 90% of FFO. If a REIT is consistently paying out more than it earns, that could mean trouble ahead. Again, let's look at Realty Income. Their payout ratio has hovered around 75% of FFO, meaning they keep enough cash to maintain and grow their properties while still rewarding shareholders. Third, consider the REIT's property type and diversification. There are many types of REITs: retail, residential, industrial, healthcare, office, and more. Each sector has its own risks and opportunities. For example, retail REITs that own shopping malls face challenges as more people shopped online. Meanwhile, industrial REITs that own warehouses for e-commerce companies have thrived. Diversification matters too. A REIT with properties across different regions or tenants is less exposed to a single economic shock. For example, Prologis, ticker symbol PLD, is one of the world's largest industrial REITs. Its properties are spread across multiple countries and serve hundreds of tenants in different industries. This lowers the risk if any one tenant or region faces difficulties. On the other hand, a specialized REIT like Public Storage, ticker symbol PSA, focuses on self-storage facilities. While specialized REITs can do well, they're more exposed to risks unique to their sector. That's why it's important to understand the REIT's business and consider how it fits into your overall portfolio. Fourth, analyze the REIT's balance sheet and debt levels. REITs often borrow money to buy properties. That's normal. But too much debt can be risky, especially if interest rates rise or property values fall. Check how much debt a REIT carries compared to its assets. This is called the debt-to-asset ratio. A lower ratio typically means the REIT can handle tough times more easily. Also, look at how well the REIT can cover its interest payments, known as the interest coverage ratio. For example, Alexandria Real Estate Equities, ticker AR, focuses on life science and laboratory properties. It maintains a conservative balance sheet with a moderate debt-to-asset ratio and strong interest coverage. This gives it flexibility to handle downturns and invest in new opportunities. Fifth, review the REIT's dividend growth history. Past performance doesn't guarantee future results, but a REIT with a long history of growing or maintaining its dividend is often a good sign. For example, Federal Realty Investment Trust, ticker symbol FRT, has increased its dividend for over 55 consecutive years. That's one of the longest streaks among all REITs. This consistency shows strong management and a resilient business model. Look for REITs that have not only maintained, but grown their dividend through different economic cycles. This signals reliability and discipline. Let's quickly recap the key terms we've discussed. Dividend yield tells you how much income you can expect, but don't chase the highest yields without understanding the risks. Payout ratio, especially based on FFO, shows whether the dividend is sustainable. Diversification, across property types, tenants, and regions, reduces risk. And dividend growth history shows the REIT's commitment to rewarding shareholders. Now, before you invest, always research the specific REIT. Read their annual reports, check their tenant lists, and look for any recent news or changes in management. Understand how they make money and what risks they face. You might also consider a REIT ETF, like the Vanguard Real Estate ETF, ticker VNQ. This fund holds dozens of different REITs, offering instant diversification and reducing the risk of any single company facing trouble. So, what should you do next? Start by making a short list of REITs that fit your goals. Look for those with reasonable yields, sustainable payout ratios, a track record of dividend growth, and a business model you understand. Remember, no investment is without risk. But by following these steps, you can tilt the odds in your favor and build a portfolio that generates reliable dividend income over time. If you found this video helpful, please like, subscribe, and share your thoughts or questions in the comments. I'd love to hear which REITs you're watching or what topics you want to learn more about. Thanks for watching. Keep learning, stay patient, and happy investing.